In 1999, the median price for a Manhattan condominium was $425,000. As of March 2026, that same category of apartment sells for $1.3 million. That is what 26 years of compounding does to the most expensive real estate market in the United States. And it raises a question that few buyers actually answer with real numbers. Would you have been better off purchasing that Manhattan apartment or putting the same capital into the stock market? The answer is not straightforward, and the numbers on both sides require careful examination. Start with the stock market, because the return data there is well documented and consistent across sources. According to figures compiled by NYU Stern professor Aswath Damodaran, the S&P 500 has delivered an average annual return of 10.39%, going back to 1992, dividends included. Over the last 100 years, the annualized figure is nearly identical, 10.42%. A $100 investment in an S&P 500 index fund in 2010, with every dividend reinvested, grew to approximately $781 by 2026. That is a 681% nominal return achieved with near zero fees, no management, and no maintenance obligations. For context on where those returns came from, the S&P 500's long-term progress has been concentrated in three major bull markets: the mid-1940s through the mid-1960s, the 1980s through 2000, and 2010 to the present. There have been multiple stretches of a decade or longer where returns were essentially flat, which means timing of entry has mattered considerably over shorter holding periods. The 10+% average obscures significant variability within individual decades. Manhattan real estate, over a comparable period, tells a different story in raw appreciation terms. From 1999 to 2025, the average price per square foot in Manhattan went from $480 to $2,099. That works out to an average annual appreciation of approximately 6% per year. The broader national housing market, by comparison, has provided approximately 5.5% annually over a similar time frame, according to data tracked by the Case-Shiller Index. On a straight comparison of appreciation rate alone, the stock market outperforms Manhattan real estate by a meaningful margin. That comparison, however, omits the mechanism that makes real estate fundamentally different from equities as an investment vehicle. Leverage: when a buyer puts 20% down on a $1.5 million Manhattan apartment and finances the remaining 80%, they are controlling a $1.5 million asset with $300,000 of their own capital. A 6% appreciation in the property's value produces $90,000 in equity gains in year one. On the $300,000 actually invested, that is a 30% return. The same $300,000 placed in an S&P 500 index fund at 10.42% returns approximately $31,000 in the same year. The leverage differential alone, even at a lower underlying appreciation rate, reverses the outcome on a cash-on-cash basis. Residential mortgage financing also carries structural protections that stock market margin lending does not offer. Brokerage firms typically cap margin lending at 50% of portfolio value, and a margin call can force a sale at a loss during a downturn, precisely when selling is most costly. A bank holding a residential mortgage does not call the loan because property values decline 10 or 15% in a correction. The borrower retains the ability to hold through the cycle, which is a material structural advantage in volatile market environments. That asymmetry, the ability to stay in the trade, has historically been one of the primary reasons leveraged real estate returns have outpaced unleveraged stock returns on an equity basis over long holding periods. The leverage advantage, however, cuts in both directions. A 10% decline in property value on a 20% down payment produces a 50% loss in equity. Buyers who entered with thin down payments near market peaks have absorbed severe losses when corrections arrive. Conservative loan-to-value ratios, generally 75% or lower, provide a cushion against the kind of corrections that have historically hit even Manhattan, which fell roughly 12% in 2009 and an additional 4% in 2010 following the financial crisis. That resilience during the 2008 crisis is worth examining in detail, because it illustrates something specific about Manhattan's buyer composition. When Lehman Brothers collapsed in September 2008 and the S&P 500 ultimately fell approximately 57% from peak to trough, Manhattan real estate absorbed the shock with a significant delay and at a fraction of the severity. Nationally, home values fell approximately 35%. Manhattan's peak-to-trough decline was roughly 15%, and it arrived a full year after the national market began its collapse. The reason is structural. A large share of Manhattan buyers have historically been cash-heavy, and the market is less dependent on mortgage credit availability than virtually any other major U.S. market. As of the fourth quarter of 2025, 75% of Manhattan transactions closed in all cash, an all-time high. For properties priced above $3 million, 90% of buyers paid cash. That concentration of liquid capital insulates Manhattan from the rate-driven demand destruction that affects most American housing markets. When the Federal Reserve raised rates aggressively beginning in 2022, pushing mortgage rates from approximately 3% toward 7%, the national housing market slowed sharply. Manhattan's median condo price that same year hit a new record of $1.746 million, surpassing the previous peak, set in 2017. That divergence from national trends reflects a buyer pool that is simply not constrained by financing costs in the way that median American homebuyers are. Return-to-office mandates from major financial institutions are drawing affluent buyers back to Manhattan for primary residences. Foreign capital has returned to the market following several years of suppression by pandemic-era restrictions and currency dynamics. And according to real estate professionals active in the market, there is a notable influx of buyers relocating from Los Angeles and returning from Florida. The demand composition is shifting, and it is shifting toward buyers for whom mortgage rates are largely irrelevant. Against that backdrop, the 2025 transaction data is significant. In the first quarter of 2025, Manhattan apartment sales increased 29% compared to the same period in 2024, with total transaction value reaching $5.7 billion, a 56% increase year over year. That quarter represented the strongest luxury market performance in 6 years. Through the first 3 quarters of 2025, nearly 9,000 transactions closed, with total sales volume reaching $19.7 billion. Full-year investment sales below 96th Street totaled $22.77 billion, up 45% over 2024, according to Ariel Property Advisors' 2025 year-end report, the strongest performance since 2018. The market recovered with similar velocity after the COVID freeze. In the second quarter of 2020, transaction volume fell nearly 60%, the largest quarterly decline on record. The city's real estate market was effectively suspended and officially reopened on June 22, 2020. By 2021, Manhattan recorded its highest annual sales volume in 32 years, driven by pent-up demand, historically low mortgage rates, and a wave of buyers who had deferred decisions through the shutdown. The speed of that recovery was without precedent among comparable global markets. That resilience, however, comes with a cost structure that is among the most burdensome of any major real estate market in the world, and the numbers deserve to be stated plainly. Buyer closing costs in Manhattan range from 1.5 to 6% of the purchase price, covering attorney fees, title insurance, appraisal, and lender fees. New York State also levies a mortgage recording tax of 1.925% on any loan above $500,000, a cost that does not exist in most other states. On a $1.2 million mortgage, that tax alone adds $23,000 to the upfront cost of entry. The mansion tax compounds that burden. Governor Mario Cuomo introduced the tax in 1989 at 1% on any property sold for $1 million or more. At the time, a $1 million property in Manhattan represented genuine luxury. The threshold has never been adjusted for inflation in the 37 years since. Adjusted to $2,026, the original threshold would sit at approximately $2.675 million. Instead, it remains at $1 million, a figure that now falls below the median Manhattan sale price of $1.3 million, as reported by Redfin in March 2026. The result is that a tax designed for high-end luxury transactions is now routinely paid by buyers making median-priced purchases. The tax scales from 1% on properties between $1 and $2 million, up to 3.9% on transactions at $25 million, and above following a 2019 revision by New York State. On a $1.5 million purchase financed with a $1.2 million mortgage, the upfront transaction costs break down as follows: $15,000 in mansion tax at 1%, $23,000 in mortgage recording tax, and an estimated $10,000 to $15,000 in attorney fees, title insurance, and appraisal. Total entry costs approach $50,000 before the first month of ownership begins, and before a single dollar of carrying cost is incurred. Those carrying costs are not trivial. In the fourth quarter of 2024, Manhattan co-op maintenance fees averaged $2.44 per square foot, up 6% year over year. Property taxes account for 30 to 50% of the average Manhattan maintenance bill, according to CPA surveys conducted in 2024. Buildings subject to Local Law 97, a city mandate that took effect in 2024, requiring structures over 25,000 square feet to meet carbon emission reduction standards, have in some cases passed compliance costs to unit owners through special assessments, with fines for non-compliance also transferable to residents. The standard professional guidance is to reserve 1 to 4% of home value annually for maintenance and unexpected capital expenditures. On a $1.5 million apartment, that reserve represents $15,000 to $60,000 per year. At the point of sale, the cost burden intensifies. Seller closing costs in New York City run 8 to 10% of the sale price. Broker commissions, typically 5 to 6% of the transaction, represent the largest single component. The city collects a transfer tax of 1.425% on residential sales above $500,000, with revenue from that tax projected by NYC at $1.334 billion in fiscal year 2026. Some cooperative buildings impose an additional flip tax on sellers, ranging from nominal amounts to 15% or more of the sale price in buildings originally converted from income-restricted housing. On a $2 million sale, total seller-side transaction costs fall between $160,000 and $200,000. A low-cost S&P 500 index fund carries annual expenses of a fraction of 1% and imposes no transaction cost to liquidate. The aggregate entry and exit costs mean that a Manhattan property must appreciate meaningfully, well beyond the purchase price, before the owner clears the threshold at which the investment begins to outperform a comparable allocation to equities. That threshold is not a minor consideration. It is the central variable in the comparison, and it is one that most buyers do not model before committing. Rental income does not substantially offset that threshold in Manhattan. Net rental yields, after common charges and property taxes, run 2 to 3% of property value for Manhattan condominiums, based on investor data from the Castle Avenue brokerage. The national average gross rental yield in the fourth quarter of 2025 was 6.56%. According to market data compiled from publicly available sources. Manhattan investors are earning below-average current income relative to asset value, with total returns dependent almost entirely on price appreciation over time. If appreciation slows or stalls, the income component of the investment does not compensate. For investors seeking real estate exposure without the cost structure of direct ownership, real estate investment trusts offer a documented and liquid alternative. The FTSE Nareit All Equity REITs Index returned an average of 11.8% annually from 1972 to 2019, slightly outperforming the S&P 500's 10.6% over the same period, per Morningstar data. By law, REITs must distribute 90% of taxable income as dividends, providing a current income component that direct Manhattan ownership typically does not. Public REITs maintain variable rate debt at under 10% of their capital structure, compared to private real estate portfolios that commonly carry nearly 50% variable rate debt, a material risk distinction during rising rate environments. REITs are fully liquid, with no transaction costs, no maintenance obligations, and no property management requirements. The trade-off is the absence of direct leverage on the buyer's capital and the absence of a physical asset. More than 45% of American households currently own REITs, nearly double the estimate from 2 decades ago, reflecting growing recognition of the asset class as a practical alternative to direct property ownership for investors seeking real estate exposure. The rent-stabilized segment of the Manhattan market illustrates a different dimension of regulatory risk that applies specifically to income-producing residential properties. Following the Housing Stability and Tenant Protection Act of 2019, which significantly curtailed the ability of landlords to raise rents on stabilized units, values for rent-stabilized multifamily assets in Manhattan fell approximately 45% to $249,000 per unit and 61% on a per-square-foot basis. Two buildings on the same block, one with free market units, one with stabilized units, have experienced radically divergent investor returns based solely on regulatory classification. That regulatory dimension is specific to income-producing properties and does not apply to owner-occupied condominiums, but it represents a category of risk that does not exist in equity markets. The comparison between Manhattan real estate and public equity investment does not resolve to a single answer, and no honest analysis should claim otherwise. The stock market offers higher raw returns, near zero transaction costs, full liquidity, and no carrying obligations. Manhattan real estate offers leverage on a physical asset in a market with a documented history of resilience during credit-driven downturns, a buyer composition insulated from rate sensitivity, and long-run appreciation that, when multiplied by financing, has produced equity returns competitive with or exceeding public markets for buyers who entered at reasonable valuations and held for sufficient duration. The entry and exit cost structure is fixed, and it is substantial. The appreciation that must overcome it is not guaranteed. For buyers who entered before 2015, held free market condominiums, and financed conservatively, the leveraged returns over the subsequent decade have been significant. For buyers entering today, at a median price of $1.3 million with $50,000 in upfront transaction costs and 8 to 10% in exit costs baked in, the holding period required to match a low-cost index fund is longer than most buyers model at the time of purchase. Manhattan's median sale price is 224% above the national average. The transaction costs are among the highest of any market in the country. The rental yields are among the lowest, and the market continues to attract the most liquid capital in the world at record volumes. Those facts are not contradictory. They describe the same asset from different vantage points. Which vantage point is relevant depends entirely on the buyer's capital position, hold period, financing structure, and tolerance for illiquidity, none of which the appreciation data alone can answer. Those facts are not contradictory. They describe the same asset from different vantage points, and which one is relevant depends entirely on your capital position, your hold period, and your tolerance for illiquidity. If this video helped clarify the math, subscribe to the channel, share it with someone weighing the same decision, and leave a like. It takes a second, and it helps this analysis reach more people who need it. Next up, what happens to your 401k when you leave a New York City job? Whether you are switching employers, getting laid off, or walking out on your own terms, that retirement account has rules attached to it, deadlines that matter, and mistakes that are difficult to undo. Watch that video next. The link is on screen.